Welcome to the Hidden Economy. If you're new here, this channel breaks down what's really happening in markets while everyone else chases headlines. Subscribe right now because this level of analysis isn't available anywhere else. And if you're finding value in this video, hit the like button. It helps get this information in front of the people who need to see it. In my previous video, I showed you the exact level around 117 and explained why silver collapsed from there. At the time, people were saying, look, it's bouncing, it's heading back to 118 or 120. But here's what happened next. When markets opened this morning, thousands of traders tried to dump their silver ETFs. Orders rejected. Circuit breakers triggered. Friday's crash was so severe that today's prices are still below circuit limits. The exchange simply refused to accept sell orders. Anyone who held through the weekend planning to exit Monday morning is now trapped. They can't sell at any price. The system will not allow it. This is happening right now as gold breaks through 4,500 and silver collapses through 72. In this video, I'm going to explain why and how to make sure this never happens to you. Here's the cause. The weapon is margin hikes. When you trade futures, you typically post about 10% margin. To control $100,000 worth of silver, you put up $10,000. That's your collateral. But when the exchange raises margin requirements overnight, you suddenly need more cash immediately, not tomorrow, not after funds settle. Right now, if you don't have it, your position is liquidated automatically at whatever price exists in that moment. One margin hike is manageable. Most traders keep a buffer, extra cash on the sidelines. But what happens when there are 2 margin hikes, 3, 4? What happens when there are 8 margin hikes in 8 weeks? That's not risk control, that's extermination. And that's exactly what CME executed. December and January were relentless, hike after hike, Christmas Day, New Year's weekend. Every time traders thought they could breathe, another margin increase landed. Then came the kill shot, January 13th. CME switched to percentage-based margins. Now, when silver rises, your margin requirement rises automatically. The higher silver goes, the more cash you need, even if you do nothing, a trap that tightens itself. And it didn't stop after Friday's massacre. Another hike Monday morning. Another one scheduled later this week. 8 hikes total. For perspective, all of 2024 saw 2. 2023 had 3. 2022 had 2. 7 hikes over 3 years was normal. 8 hikes in 8 weeks has never happened before. I went back through 20 years of CME data. This is unprecedented. Each margin hike forces selling. Forced selling pushes prices lower. Lower prices trigger margin calls on traders who weren't even impacted by the original hike. More forced selling, more price declines, a self-feeding death spiral. That's what you're watching unfold right now. But here's the part that actually matters. The same day CME raised margins, the Shanghai Gold Exchange raised margins too, from 20% to 26%. Same day, same direction, same move. Chicago and Shanghai, 14 time zones apart. The US and China disagree on almost everything. Trade wars, sanctions, constant tension, yet on silver margins, they moved in perfect sync. That doesn't happen unless both sides are afraid of the same thing. And here's what they're afraid of. On COMEX, there are roughly 356 paper ounces for every single ounce of real silver. 1 real ounce. 356 paper claims. That system works only as long as everyone settles in cash. But once people demand physical delivery, the math collapses. In the 3rd week of January alone, 33 million ounces of silver were physically removed from COMEX vaults. Not traded, removed, loaded onto trucks, gone. That was 26% of all registered silver in a single week. 4 years ago, COMEX held 430 million ounces. Today, it holds around 113 million. Nearly 3/4 has disappeared, and the pace is accelerating. This isn't retail buying. You don't move 33 million ounces without trucks, security, logistics, and storage. This is institutional money manufacturers, sovereign entities, smart capital, and they're draining the vaults ahead of March. And March is critical. March futures represent 528 million ounces promised for delivery. The vault holds 113 million. Read that again. Nearly 5 times more silver promised than physically exists. First notice day is March 27th. If just 22% of contract holders demand delivery, the vault is empty. What happens when the 23rd% shows up? That's the scenario CME and Shanghai are trying to prevent. That's why longs are being shaken out now. Now here's the smoking gun. Look at 2 prices. COMEX silver, the paper price around $72 and falling. Now look at Shanghai silver, the physical price around $100, same metal, same day, same planet. A 28-hour difference. Nearly a 40% premium for physical silver. If silver were truly worth $72, no rational buyer would pay $100, especially not Chinese manufacturers who rely on silver to operate. They're paying that premium because they know the paper price is artificial. And here's the key point. The gap isn't closing. Friday, it was 24 hours. Monday, it was $30. Today, it's still 28 hours. Paper is collapsing. Physical is holding. If this were a real crash driven by fundamentals, both prices would fall together. They aren't. One reflects reality, one doesn't. So ask yourself, who benefits? JP Morgan holds the largest silver short position in history. Bank of America, HSBC, all heavily short, all deeply embedded in exchange committees. I'm not alleging crimes. Short selling is legal. Committees are legal. I'm pointing out that the institutions with the most influence are also the ones making billions as prices collapse. Timing matters too. Thursday night, Reuters published a story claiming the U.S. government was ending support for strategic metals. Anonymous sources. Algorithms triggered massive selling. Hours later, the Energy Department issued a statement saying the article was false, completely false, but the damage was already done. That same night, Kevin Warsh's Fed chair nomination leaked. Hawkish, negative for metals. Official announcement Friday morning. Insiders knew Thursday. Add 8 margin hikes, fake headlines, leaked nominations, all in the same window. Coincidence? There was also unusual options activity the day before the crash, massive put buying on silver ETFs. Someone placed a very large bet on a collapse before it happened, and when traders tried to exit, they couldn't. In China, the UBS SDIC silver fund was completely halted. No trading. In the US, leveraged silver ETFs lost more than 60% in a single session. Traders faced rejected orders, frozen platforms, hours-long delays. Some were locked out for days, crash the price, lock the exits, raise margins again. That sequence tells you everything. And here's what makes this crash even more insane. The fundamentals haven't changed. Silver has been in a supply deficit for 5 straight years. Solar, EVs, AI, electronics. Demand keeps rising, mine supply doesn't. Since 2019, the cumulative deficit exceeds 1.3 billion ounces. On January 1st, 2026, China added silver to its strategic materials list. Export licenses required. Volumes down 40%. China refines 65% of the world's silver. There's no backup supplier, yet prices are collapsing. That only makes sense if paper is being crushed ahead of March delivery. So where does this end? No one knows the exact bottom. Anyone claiming certainty is lying. Support levels don't matter during forced liquidation. Signals do. Watch the Shanghai premium. Watch COMEX vault levels. Watch lease rates. Watch March open interest. Watch trading halts and platform freezes. Lease rates are near 10%. Normal is 0.5%. Institutions don't pay that unless metal is scarce, vaults are still draining, smart money is still taking delivery. March open interest remains elevated despite the pain. The fundamentals haven't changed, only the paper price has. Paper can be created endlessly, metal cannot. That truth is held for 5,000 years. Crashes don't destroy wealth, they transfer it. The question is which side you're on. Paper at 72, physical at 100, that gap will close. Someone will profit when it does. Know your exposure, size for survival, manage risk. The winners aren't the ones who predict perfectly. They're the ones who stay alive long enough to act. Drop your thoughts in the comments. Share this with someone who needs to see it. Subscribe. I'm covering this daily until it breaks. See you tomorrow.